Hello and welcome to the Jake and Gino podcast. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in today's podcast, we have Kent Roers. He's a seasoned real estate investor, entrepreneur, and community builder with decades of experience in multifamily development and acquisitions. As co-founders of Roers Companies, he has led billions in real estate projects while mentoring the next generation of leaders. Kent values faith, family, and creating lasting impact. Welcome to the show, Kent.
Thank you so much, Gino. Excited to spend some time with you here this morning.
And listen, we're going to go right outside the box. We usually want to get to know you a little bit better, but you piqued my interest. And I really want to focus this topic and this podcast on the institutional investor versus the individual investor. And where do you land? Give me the pros and cons of both, because, the world isn't great. It's not like, institutions are the best. There's no downside. And individuals are the best. There's no downside. There's pros and cons to both. So I'd love to hear your take on that and why you focus on one more than the other.
Yeah, great question. And probably the segment that sets us apart from most others in the industry. A lot of folks, and we get called by a lot of institutions, they will tease me. They'll say, "Hey, when are you ready to become a big boy, Kent? And when are you guys ready to step up into the institutional market?" And I always laugh, and I'm like, "That's funny." And I'm like, "Let me guess. I should work in the big boy market because it's one check. I just need one point of contact. And you guys, once you vet us, then there's tons and tons of money, and I mean billions and billions of dollars to flow after that." And they're like, "Yes." And we're talking name brand household firms that are in that market. And I just have to chuckle because Brian and I, when we started full time at Roers Companies here 12 years ago, he bet me that he could raise more money going the institutional route than I could with individual investors, just your mom and pops and next door neighbors and you name it. And he finally came into my office after like 6 months and he threw down a stack of papers and he's like, "I'm done. I give up." He's like, "I just had 5 attorneys on the phone and they were spending 20 minutes arguing over his, him, her, the company, or what this word should be called." And it was just, there's just so much red tape and it just takes so long. And the money, quite frankly, comes and goes. And with our individual investors, we've been able to consistently raise money and by increasing amounts each and every year that we've run the company here for the last 12 years. So that's where we've decided to take the money.
It's interesting, Kent. You said that the year 2012, Jake and myself, we started investing in 2011. And everyone can go back and say that was the best time to start. But Kent and Gino, we both know that it sucked back then. It was really hard raising, let alone institutions, mom and pops. Everyone was afraid. What made you decide in 2012, like, I'm planting my flag and I'm starting in 2012?
Yeah, interestingly enough. So Brian and I started probably in around 2002 buying single family homes and duplexes. And it just got to the point where we even got up to 20 houses around the University of Minnesota here in the Minneapolis, Twin Cities area. And then we did 20 lease-to-owns where we would run little ads in the paper that said, lease to own your own house. And in the very beginning, we would, again, take a renter. We would let them choose 3 houses that we thought were good deals in the neighborhoods or areas that they kind of wanted. And then we would pay off their credit card debts. We did everything. We were so naive. We were straight off the farm. And we really did help and do a lot of good things. But what we noticed was it was so hard without that scale to ever start to really, truly make money. And by that, what I mean is, if we had a single family home and all of a sudden the air conditioner went out one year, well, there was 3/4 of the money you were going to make, or sidewalk needs to be replaced, or the front steps, well, there goes your profit for a year. And so just that upkeep, just because we couldn't get enough size, we couldn't make enough money. And so we knew we needed to get into something of the apartment type world where we could have more scale. But everybody I met and talked to wasn't offering that. And so, I'd say, "Hey, can I invest in your apartment?" "Well, I don't want investors. I don't know how to do it," so on. And so, it was just difficult to break into that market. And yet when I was a certified financial planner. And after college, for the first 12 years, I sold investment products in all the major brokerage firms. So I was walking through Merrill Lynch, UBS, Morgan Stanley, you name them, all day long, selling investment products to the brokers that would then sell it to their clients. And when people would ask me, "Hey, what are you doing with your money, Kent?" would say, oh, I'm investing in houses and here's what I do. And I got the same response from everybody. And that was, hey, the next time you get an opportunity like that, let me know. I'd like to invest with you. Well, you hear that 300 times, Gino, and after a while you say, hey, maybe there's something here for me. I can't find the ability to invest in apartments. And these other people are telling me that they trust me or they like me or they'd like to invest in. Everybody likes the idea of this different asset class, real estate. But again, if you price out the cost of a home today and what you can get for rent and you add in taxes and insurance, you don't really make any money. And so then you're banking all on appreciation. As we all know, that's a scary investment. And so in 2011, 2 weeks before Christmas, I'd gotten laid off for the third time in the financial industry. And I just said, you know what? That's it. I'm going to start my own firm. My parents were entrepreneurs. I was an entrepreneur in the beginning. I jumped on the corporate ladder and done really, really well. And so this was an opportunity for me to, as you put the stake in the ground and say, you know what? That's it. I'm starting Roers Companies. I'm going to go and talk to everybody and anybody I've ever met in my life. And I literally did that, right? And I'm going to start my first 30-unit apartment. And I went out to Western North Dakota and we started housing oil workers out there.
Oh, wow. I want you to be honest with me, Kent. Like, it's very difficult being a certified financial planner. Isn't that a difficult space to be in? Because I've spoken to several, and when you're trying to plan people's finances, you're getting into the psychology of money. You're trying to sell products. And I've talked to some who have had the epiphany of coming into the multifamily space and going, wow, I was in the wrong business. Can you give me a feeling of how you felt in that financial world? And I mean, it seems like by the third time you were done with it. It seems like, you know what? I don't really enjoy this as much as multifamily. Can we go down that little rabbit hole?
Yeah. Yeah. So again, I was good in what I was doing. I mean, when I got laid off, I was like number 2 out of 150 salespeople. So
Wow.
A, I was making really good money. B, I was really good at the job. But in that space, everybody thinks that everything has to be, S&P 500, mutual funds, stocks and bonds. That's like the world. And when you get outside of that, not as popular and not as well known, but that is what is attracting people, right? If you take a look at, the Harvard endowment, the Stanford endowment, all these major billion-dollar funds, they've done better than the stock market. And it's because 50% of their assets are in alternative assets, right? So they're buying, a lot of real estate. I mean, right now a person should be, 10%, 15% of their portfolio in real estate, at least for the average person. And it's tough to find true real estate when you're in that, brokerage or stock market type space. Because as you know, and I'm certain you talk about it, people can buy a REIT, which is a real estate investment trust, but that stock price goes up and down, completely locked into the stock market, where the value of an apartment or a house should not change if the Dow Jones drops 2,000 points tomorrow, right? And then pops up the next day. So when I was in that space, it was all about, you should be 60% stocks, 40% bonds. You want to be able to sell in, all your assets with the click of a button. And then when you start to get into real estate, all of a sudden you're like, wait a minute. There's an asset here that's hard. You can touch it, feel it, kick it, right? And it produces a consistent cash flow, right? And the appreciation is greater, I think, than a stock, and we've proven it in our returns. And yet you get a tax loss for it as well, and you get to leverage it up. So it once you start to do some research into the real estate space, it has a lot of I would say accolades that are better than the market. And yet so many people, they just don't know of people like you, Gino, or people like myself that they can actually invest in and get that exposure.
It's interesting. I've got 6 children. My 3 oldest children are invested in my deals. My son has got 9 K1s. He's only 23 years old. My daughter, who's 26, has got 4 deals, and my 19-year-old is in 3 deals. So we just did their tax returns. So I have a call with our CPA at 12 o'clock because I want him to go through the tax returns because they have a cash gain on their investments, but there's a loss or very little. And I'm trying to make them understand what cost segregation is, what depreciation is, because you can never, quantify how much you made in the stock market versus real estate. You can't do, it's not an apple for apple kind of investment. That's what, and to them, they're very young. They don't understand this. Most adults don't understand that. So when you're looking at real estate, look at it, what Ken is saying, from a holistic point of view. And there's one thing that I really wanted to come back on. If you're buying single family homes, it's not that it's a good or bad investment. It's a different strategy. If you're buying one home a year for the next 5 years and you're going to retire in 20 years, that's probably a really good strategy. If you like to keep your business, your W-2, and you're earning money and you can live off of that, and you have your homes on the side and they're gaining equity and you're beating inflation, you have the tax benefits there, that's a good strategy. But what Kent wanted to do was, he's like, I don't want to really be doing this. I can't be making money on this full time. I need to scale up. And that's the difference. So don't think single family is better or worse. It depends upon what you're trying to accomplish. And most gurus won't tell you that. They're going to tell you this is the best thing for you. So you have to understand that. And I think that's really important. The single families are great, but if you're going to try to build a business, I think it's a lot more difficult trying to buy 10 or 12 single family homes than what you did with your first investment of 30, of a 30 unit apartment complex. When you tell your family that and you're like, I'm buying a 30 unit apartment complex, what was their response? What did they say to you?
Well, it's so funny. So most of my family, because that's who I went to, right? So I needed to come up with $1.5 million in equity, and I was going to do a $3.5 million loan. So it was a $5 million property. And first off, I didn't have the balance sheet. So I needed the investors to also sign on the dotted line. So I had a lot of people. It took me 6 months to do that first deal. Now we raised probably $3 million a day. So it comes with 12 years of experience. But in the beginning, again, I went to my next door neighbor and he gave us 50 grand. I went to my parents, they gave me 100 grand, right? I went to my brother, he gave me 50 grand. I went to my uncle, he gave me 50 grand. But a lot of people would say, in the very beginning is, hey, Ken, what's your experience with this? And I was like, nothing. They're like, have you ever built an apartment? I'm like, nope. They're like, have you ever managed one? I'm like, nope. They're like, you don't have the balance sheet to do this. I'm like, nope. And they're like, so why would I do this? And I'm like, well, just look at me. I can do it. And, I had enough people that were like, you know what? I'll roll the dice with you, Kent. And they did the first deal and we did that. And then we did, before that was even finished, we started the second building, then the third building, and it just kept rolling. And so that's where, again, we started to create that momentum. We kept thinking, gosh, we're going to run out of investors or we're going to run out of names. But, between my brother Brian and I, we own the business together. We're 50-50. He, after college, was a certified public accountant. So he went the accounting route and then owned his own accounting firm. He had 9 employees. When we joined up, he wound down his firm. I jumped over. We combined forces. So he's amazing at running and operating the finances and the teams and the people. And I'm better. And I would go to events and meet people. And then I'm like, oh, by the way, you should invest in our real estate. I mean, I would go to anything where there was people and I would ask people for referrals and introductions and their friends. And so I was just running the face of it and raising money. Just to give you an idea of magnitude, Gino, we just next Friday are celebrating it, but I guess this Friday we're celebrating it, but we just hit 4 billion in what we've developed since 2012. We're hitting 15,000 units that we've developed, and then 100 projects.
Wow! And so that first 30 unit, you built it. You didn't buy it. You actually built it from ground up.
We built everything. Of those 100 projects that we've closed, meaning we've started construction on, I think 2 of them we've bought. The rest, 98 of them, we've built.
Brother, you're nuts. You're like, buying a 30 unit is one thing. That's a little challenging. Building a 30 unit, I would not have given you money. I'm not going to lie to you. That's a challenging one. That's really, 30 units is not, it's not 300, but it's still 30 units. You've never done it before, getting into the construction side of things. So you had some great positives to your side. 2012, labor costs were low, land costs were lower. So but I don't want anyone to say he got in at the right time because everyone was afraid. It was very hard to attract capital back then. Debt was very difficult. How did you overcome the debt component with the banks? Because the banks must have said, Mr. Kent, you're in the wrong industry here. You're a financial planner. You're not a multifamily guy. What did you do to convince them?
Yeah, well, first off, I would say that prior experience set me up to be able to do that, right? And then secondly, once you meet somebody, right, you get a feeling or an understanding for them. And so, I would go through the history of where I was and what I had made in money and what I had saved and how much I was putting into this. But yeah, I mean, the bank was like, look, Kent, we can't give you a $3.5 million loan when you're not worth $3.5 million. I always, and that's where I was naive. I thought banks lent money and just, again, would take chances. Oh no, you have to show them $3.5 million worth of money or opportunities and assets to get $3.5 million, right? You've found that out yourself, Gino. So what I had to do was get the investors to sign on the dotted line. My investors would help me do the personal guarantee. So for instance, to give you an idea, if somebody put $50,000 into our apartments deals, they'd have to sign on the personal guarantee for about $250,000. So everybody to this day is like, how did you do that? I got to be honest. I don't know that I could redo it, but back then I didn't have another opportunity and people wanted to get into this space bad enough, right? Today we personally guarantee our own lines, Brian and I. So nobody has to be a part of that. So that's very different today. And it probably changed back about 7 years ago. So it was after we were in business for 5 years. But we had some really good investors that really believed and trusted in us. And I had always networked and met business owners and asked them their story and got tours of their businesses and all that. So I had a lot of people that knew me, trusted me, and liked me. But that was a big ask.
It's interesting because the excuses are starting to evaporate for anybody listening now saying, I can't get in, because that's a really big one. Because if anybody knows to get investors to personally guarantee, like you said, they're listening going, well, you can't do that now. Well, times have changed now. Things are different. And that's I'm just trying to think, very interesting. Hey, did you have any investors on that first or second deal that didn't invest? Then they hear you doing the thing and now they're like, oh, when can I get on board?
All the time. Yeah, pretty much anybody who said no, I always laugh and say it's not no, forever. It's just no now. And so many people come back and they're like, oh, I remember that deal you showed me. For instance, like we did a deal down in Lakeville, the southern part of the Twin Cities. And I had so many people tell me no, because it was right when COVID broke out. And I literally had some people that are like, Kent, you're nuts, and hung up the phone on me. Because I was like, wait a minute. Nobody has work. COVID just broke out. It's super scary. And so I said, you know what, let's grab this land and let's go now. Because I called the excavator. He's like, I'll do it for, I'll do it making no money. I just got to keep my guys working. Then I called the cement guy and he's like, I have no work, Kent. I need work badly to keep my guys going. I'll do it for nothing. And it was all the way up and all the different components of the building. So we got it done for one of the cheapest, project costs we'd ever seen. Well, then we weren't even done and not even filled up. And we had offers come in. We made our investors, not myself only, our investors net of our expenses made 120% in 26 months. And in 2022, we sold 12 buildings. I mean, we were selling most of them around 100% rate of return. So that's why our average return today for anybody that's invested with us, all of our deals, our average return is 19.7% per year.
Per year. And how do you get deal flow? How's the deal flow coming to you right now? Or even how has it changed? Because I wanted to ask you how building has changed over the last, market cycle, but how has the deal flow changed for you as well?
Yeah, so the deal flow has changed some, but mainly by our doing. And I'll talk through that in two parts. So number one, all we used to do was referrals and networking, and that's what I spent a majority of my time doing. And then we've changed in the last year. We started to mix into that doing some Google clicks and AdWords and other stuff. So we're trying to get our name out there, and that was the way to do it, on the deal flow side of stuff. So we're really trying to grow that client base of ours. And then, now different than when I started, when people say, well, what's your track record? Okay, well, we've done 100 projects. Here's the ones we've sold. Here's our average rate of return, 19.7% per year, right? And again, I always told people you're going to make less than the stock market. It's an illiquid asset, but it's something that you need in your portfolio. It's steady and stable and so on. And now it's turning out that the returns are better than the stock market. And so people have really started to continue to come back to us. And our average investor probably has 8 projects with us. So once they invest once, because every 2 weeks we send out a construction update. And then once the project's operating, every quarter we send out a quarterly report that's written and all the financials. So people feel like they're really well informed. And that was my biggest thing when I started this because I had invested with others in hotels, apartments, other deals. And they, once I gave them my money, I never heard from them, right? I'd have to call them to get information. Well, our firm is specifically built to work with individual investors. So we just know, and that's just the cadence of how we do things.
We focus on buy right, finance right, and manage right. That's our three pillars when we're buying an apartment complex. What is your buy right criteria when you're looking at a piece of dirt or looking at a possible opportunity? What are you looking for in that opportunity?
Yeah, well, I think first it's is it the right location? Is the land being bought at the right price? And then it's just dropping the numbers into a pro forma, right? So the numbers just tell you. I mean, we have projects that come back and it's like, oh, because the land's expensive, because the building is more expensive. For instance, like, again, we have 4 satellite offices. We're in Phoenix, we're in Austin, we're in Tampa, we're moving into the Carolinas. But in those markets, like for instance, I'll give you an idea. In Arizona a year ago, 2 years ago, you would have to build a unit for $20,000 more than in Texas, but the rents were the same, right? And so that's a simple math equation. We're not going to build in Arizona, right? For market rate apartments, we do affordable housing there, but we don't do and never have done any market rate projects there because I'd rather swing over to the Southeast. I'd rather build in Florida and Texas because the rents are the same, but the construction prices are cheaper. Arizona, for some reason, it was just really hard to get our trade partners, those subcontractors, and they can give you high pricing because they're so busy.
So when you talk about location, you look at schools and median income, and you look at any, as far as population density, downtowns, closer. What are you looking for as far as that goes?
Yeah, I think the biggest parts are, number one, what are the metrics behind the scenes? So for instance, is there job growth? Is there job demand, right? What is, to your point, what's the median income? And then, again, are people moving into that area, right? I mean, you compare, take like a Chicago, take an Illinois or a New York versus a Florida or Texas, right? And one of the funny things we take a look at, Gino, that I tell people because it's non-political, right, is the U-Haul map. So U-Haul comes out with a study every year that shows where are their trucks leaving and where are they going to and building up, right? And so it'll show the states that people are leaving. It's all of them that we know about, right? It has nothing to do with politics, but it's New York, it's California, it's Illinois, it might be the Seattle, Washington area. And where are they all going to? All the trucks are piling up in Florida, Texas, now the Carolinas. I mean, the Carolinas are getting to be rated one of the top places. So we are starting our first apartments over in those states right now too.
Kent, it's not politics, it's policy. Let's separate the both. Politics drives policy and it drives affordability. I was living in New York. I came down to Florida. I saved 6% right off the bat. You're making 200 grand a year. That's 12 grand. My property taxes were 30 grand for an $850,000 home. I moved into my home right now, which is worth over $2 million. My property taxes are $15,000. If I had the same home in Florida, the tax would be 50. So I'm up 40 G's just by moving. And I think that's the problem that people don't understand. And I think if you're going to look at the long-term demographics, and the other reason why I did it, and I want people to understand this, I did it not only for myself, because I could afford to live in New York, but when you have 6 children and they're graduating college, they're not going to be able to afford to buy a home there. So I said to myself, let me go somewhere that's a little bit more affordable, that's cheaper, and that hopefully that they can, whether they want to go to Georgia, Florida, Alabama, I'm around. I think people need to understand that. And that's why multifamily really is job dependent, population dependent. We're really supply and demand. You build an apartment complex, you want people to be able to rent it. If they're leaving or there's not enough demand, you're not going to get your rents. Is that correct? I mean, would you say it's policy, not politics?
I would agree with you.
And that's the thing that bothers me about this whole thing. Just look at it from an apolitical standpoint, because if you're in business to return money to your shareholders, and you're a financial steward to your hundreds and hundreds of investors, and that's what you're looking to do. I want to ask one question before we go to the short answers. AI. Have you guys adopted AI in being able to underwrite deals, being able to do research, being able to have customer experiences with your investors? How have you been able to utilize AI in your real estate business?
Yeah, so we are using AI. I have wanted and am pushing for it to be more direct. What we're noticing is that all of our systems are integrating AI, right? So for instance, on the management side, we have these bots that answer, because a lot of the questions people have is what's your location? What's the rent? Very simple answers. And so we have AI that's incorporated into all of our software, and that's on the management side. That's on our accounting side, right? We're getting more accounts payable, accounts receivable done by some of those systems. So, but where again, I was hoping and wanting us is us as a firm more direct. I think there's again opportunities there. It's just we have to understand. I mean, the markets are challenging. We're trying to fill up a lot of apartments right now, and there's been a lot of supply brought to the markets here in the last year and a half. And so, we've got daytime jobs that we need to then again think more strategically forward. And that's where Brian and I, as the CEOs, are trying to spend some time, group by group, is what are some smaller wins that we can get right away using and utilizing AI. But it is majorly coming in. It's just coming in more from the software and the systems that we use faster.
Yes, love that answer. Let's take a quick time out to hear from our sponsor. This episode of the Jake and Gino podcast is brought to you by Wheelbarrow Profits, the premier multifamily education community. Wheelbarrow Profits proof is in their results. Their members have closed over 86,000 units. That's over $5 billion in student deal volume. Are you serious about taking your real estate game to the next level? Do you have the confidence to take action? Schedule a call with the Wheelbarrow Profits team today and supercharge your real estate knowledge. Build lasting relationships through unparalleled networking opportunities. Obtain lasting knowledge on how to buy multifamily real estate with intensive training. Gain hands-on experience through their live events with like-minded individuals and industry professionals, all while experiencing the personal touch and family atmosphere that set them apart. Visit wheelbarrowprofits.com for more information. And we are back. I sort of lied. I said I was going to ask the short answer question, but this one slipped my mind, and I want to paint the picture for everybody listening right now. You've got Kent, who seems like the sales guy, loves going out there. He's making it happen. He's really more of an extrovert. And then you have his brother, Brian, who is the systems guy. He's the engineering guy. He's got that engineering mind. How do you make that relationship work? Because you're really, I don't want to say you're polar opposites, but you have two very different skill sets. You're the one who wants to sell the things. And Brian, I'm assuming, is, I don't want to say the more conservative, but he looks at things just from a number standpoint. He says, but you may see opportunity and he may, see it a different way. He may be more engineer driven. How have you been able to make it work and been able to produce almost 20% returns for the last 10 years?
Yeah. So very interesting. So in the beginning, it was more, we had to define and talk about it a little bit more. In 2017, we rolled EOS in, so the Entrepreneurial Operating System, which really clearly helped us on our roles. But I'll go to the very beginning. So in the very beginning, Brian said to me, hey, Kent, one of the things is you have energy and all these ideas and everything else. Number one, you can't share it with all of your employees because it distracts everybody, right? Number two, he said, I'm going to never say no. I'm just going to share the terms and the parameters. So for instance, in the beginning, he came in, we had a New York firm that was coming in. It was a family, so it wasn't clearly an institution, but they wanted, this whole deal. And of course, it was 200 pages. And Brian read through 3/4 of it, and he's like, that's it. And he flipped over the piece of paper, and he's like, here's the 7 things I need, Kent, or that we're going to do for us to be comfortable with it. And I said, no problem. So he just got on the phone. I called the individuals, and I said, hey, here's the first deal we need to talk through. Okay, we can agree to that. Second deal, third deal. So of the 7 terms that Brian needed changed for him to be comfortable with the deal, we got 6 of them changed, right? And so it was just very easy. I said, that's fine, Brian. I love that you didn't say no to the deal. You just said, here's what we have. And we're going to have people that, and which they did, different firms and groups that wouldn't do stuff, but then others did if they wanted it bad enough. And so that was in the beginning. And then the second part is when we rolled out the Entrepreneurial Operating System, EOS, I would say it was one of the top 3 things that has made our firm successful. Is we could clearly see our roles and who was doing what, right? So if he was getting in my lane, I would remind him of that. If I was getting in his lane, he would remind me of that. So EOS really helped us to understand who was doing what. Otherwise, we were the normal entrepreneurs and running around with our heads cut off, doing a little bit of everything before then. So that really helped us.
It's interesting. It's around the 5-year mark. The same thing with Jake and myself. We had started in 2011. early 2016, I had just left my restaurant to go into the real estate full time. We had about 600 units and sort of the same thing. We had no software. We're running around. And like you had said, when you have 30 priorities in a quarter, you have no priorities. When nobody's held accountable, it was like it was a life-changing thing, EOS, and we did some scaling up with Vern Harnish's group, and that truly helped us continue to grow. Let's touch on the supply and demand issue right now. It's very interesting because it seems as if we're starting to peak. It seems as if the apartment numbers right now, I saw August's numbers, rents are pretty much down all over the US in a lot of the markets. Ironically enough, in Minnesota, where they've increased supply, they don't need to have rent control to get rents down. You just need to build more. And it's just so obvious to anybody in the business. It's so annoying when you hear this. It's not, you don't need rent control. You just need more supply. What are you seeing going on in the various markets that you're at right now? Has supply stopped? I mean, has it hit top and you're seeing a lot of vacancies and a lot of concessions being burned off? What is going on in your markets?
Yeah, so in the markets that we're in, we are definitely seeing the topping of those apartments. And we had an annual investor conference here where we had a guy come in and speak on the apartment market industry. And what he showed was a bar graph, and I can send it to you, Gino, and you can show it to people because it's public data. But it shows that our apartments peaked. And it was Carl Whitaker from RealPage, I think. Have you?
Yes.
Okay.
Yeah, I
So
know.
he
Carl
showed
Whitaker.
us a graph and our investors that showed that we had the most apartments delivered in 2024 as we did back in the early 70s, right? And so in showing that, you say, then why did that happen? Well, that's because 2021, we had interest rates at zero, right? And so our loans back then were 3%. So was everybody else's. The banks were flush with cash. So anybody and everybody could be a developer and do development. Well, now all those units were brought on in 2024. We're in the markets like Austin, Texas, where there's 10% vacancy, right? We've had to lower our rents tremendously. We've had to offer big concessions here, even in Minnesota and elsewhere. But what we're seeing is that where we were offering a 3-month free rent, now we're at 2 months, right? And our team is telling us, hey, in another 6 months, we'll be down to 1 month and then probably zero, like we were a couple of years ago. So we see it in the Twin Cities market. We see it in, the Austin market, but new construction permits on apartments is something you can easily pull up and track. And those new permits are down, 60%. And so that's why we're continuing to drive forward with persistence, grit, and drive, because now is the tough time. It's tough to get banking. That's a whole nother story. But on the construction side, that's why we're continuing to build, because I truly think, and this is my personal thought, I think 2027 will be like 2022. And again, in 2022, that's when we sold all of our apartments, more than half of our supply, and we created that 120% net return to our investors per deals. I think we're going to have that happen again, because it's tough to build right now. When you say there's a slight over demand or oversupply of apartments, there's vacancy, rents are down. But what's happening is when you're not building new apartments and the demand has been consistent, they are starting to gobble up that oversupply. And we'll be right back into a financial housing crisis here in a couple of years from now. And there's an old saying, and I heard it from a vet once, who said, you don't pass, like when you talk about race car driving, you don't pass on the straightaways, you pass on the corners. And we're in a corner right now, meaning it's difficult. We have a deal down in Naples, Florida. It's 10% interest for a construction loan. It's like, really, Naples? And you name it, wherever we're at, the interest rate costs are high. But I say it's almost like biting a bullet, like bite the bullet. It's expensive construction financing. But we just refinanced an apartment that we, had, got to 95% filled here a month ago, and 6 months ago, and a year ago. And when we go to the permanent market, meaning like Fannie and Freddie, and we take out that construction loan, we're getting 5% interest rates. So it's just like, we see that we'll get this lower, and that's before, right, the feds have dropped interest rates. So we just know that we got to bite the bullet, we got to build. But what we're noticing is the construction cost is down dramatically because there's not a lot of apartments being built. So we're back to, I tease people. I'm like, everybody's concerned about my family right now. And people are like, what are you talking about? I'm like, oh, I got the cement guy. He's like, hey, kid, how is your family doing? Or I got the excavator, or I got, framing people. And I'm like, oh, you haven't cared about my family the last 2 years, right? They're all concerned about my family right now because they just want to know. And they all say, hey, I'm wondering if you're working on anything. And I'm like, yeah, we're always working on stuff. You know that. And they're like, I know we need work. And I'm like, yes, I know that. So
Sounds like brokers, Kent. It sounds just like real estate brokers. 2 years ago, they're like, I got 30 calls to offer. If you're not 10% above asking, don't even waste my time. Now it's like you send in a confidential, you send the NDA, and all of a sudden 3 seconds later, you get a text message saying, hey, I got your NDA. Can you please take a look at the deal? It's like, wow. It is amazing. This is for anybody listening. Always be like Kent. Always be affable, be likable, always be doing business. And whether it's a good time or a bad time, always be out there networking, trying to add value. Because when the market does dip, they're going to be calling you because they remembered you when it was good and when it was bad. I find that to be very interesting. That probably goes across all spectrums of business, don't you think?
I do, and it's the old saying of being humble, right? Because we have a lot of people that are like, oh my gosh, you guys have done so well and this and that. And I'm like, look, we got our heads down. We're working hard. We're continuing to grow. And the main reason we grow is we just want to continue to offer opportunities to our employees. So, the old saying from Warren Buffett is, be greedy when others are fearful and be fearful when others are greedy. And it's true. It's harder to do. But if you treat people right, for instance, we had a deal a couple of years ago, and again, we sold it in 2022 when we were selling all the others. But we had a deal that we'd opened up right before COVID. It was a student housing deal. We ended the deal at a break even. So what we built it for and what we sold it for over a 4-year period of time, we broke even on. And everybody knew that because, again, we send out financials quarterly. And at the end, though, we sent everybody a check for 2% income per year that we had it, right? So they got 8%. And they all called us up. They're like, wait a minute, we've seen the financials. We sold it for the exact same price as we bought it for or built it for. Where did this come from? And Brian and I said, well, we pushed our shares and our ownership into it. And so that's why you got your return that you did. And everybody said, you know what, we've never seen a GP do anything like that. And we're going to roll all of our money in that deal 100%, and we're going to invest more. And so it's just one of those things, when you do what's right, people respond to that and they remember that, right? And so, it's weaved into our values. We have values of teamwork, integrity, ownership mindset, work ethic, and passion. And it's really what we're about. So as you can tell, I'm very passionate, but, I work, a lot of hours. So I got the work ethic. And then we want everybody to act like, Brian and I do. We have ownership mindset. We all own this company. And that's both on the revenue side and the expense side.
I've got to share a story with you. Back in 2016, I came down to Florida and I'm hanging out with a couple of real estate guys. And one of my buddies says to me, I'm getting in this built to rent thing. And I said to myself in my own mind, I'm like, idiot, what a stupid idea. Building homes and you're going to rent them out? Like, how does that even make any sense? Well, little did I know, land values in Jacksonville at the time were really cheap. You could build these things for like $120 to $130 a door and rent them. I completely missed the boat on that. And like, those who shall be humbled will be exalted, and those who shall be exalted shall. So I was sort of a humbling kind of experience, but I just didn't see it. And I know your product is not built to rent. You stayed in the multifamily space as far as going up. What made you steer away or not get into that built to rent space?
Yeah, it's just simply that the land costs just don't work. I mean, we've wanted to do the build for rent, and we've looked at many opportunities to do it. We just can't pencil the numbers for the land cost that's out there. Typically, we need to add more density, so we need to build up, versus just sideways. And so, again, that's why we've continued to offer it. I would love to do it. Again, we've looked at it in Nashville, in Florida. We've looked at them in many deals, and you have to go so far out of town to get land that's affordable. And then you got to worry about the utilities and everything else. So we just haven't been able to find the right land and stuff to do that.
Kent, last question. If I'm listening to this and I've been buying multifamily, because I think once you've been doing it for a while, if you don't want to jump into development and you want to buy multifamily, it's always a good idea maybe to diversify. Like you're buying multifamily, you've got your cash flow coming in every month. Maybe you want to take a project that's a little bit longer of a scope that takes 24 to 36 months to actually be able to exit, crystallize that equity, where you have some deals coming in, or even if you have a W-2 job or you have some self-storage. What would you recommend to the listeners about how do I even start building a 20-unit apartment complex?
Yeah, I mean, it's tougher because like we do 200 unit deals nowadays because of scale, right? Because you got to hire an employee and you got to have a maintenance person and a sales associate, and it takes the same amount of manpower to run an 80 unit apartment as it does 200 units. So we've just been able to scale up faster. But I guess to the average listener, I mean, you got to get started, right? And so again, it's a lot of work. I don't know if the money's worth it, to do single family homes in my own opinion, right? But start there, right? And then try and do and get into the 20 unit project. Again, I got lucky. I partnered up and hired a great architect. Then I hired a great contractor. And so, we had a lot of things that fell into place for us. And then again, we tend to run really fast. I mean, to give you an idea, I could go into a whole vertical integration story about our company, but we started a construction company. We hired 100 people in that construction company in a 18-month time frame, and we're doing 25 projects now at a time, right? So we build and start 12 new projects a year. So since they take 2 years to build, we have a doubling up effect there. But it was just because we think we can do a better job. We were able to hire better people, and we were able to create a more seamless transition between our companies, right? So you got first development, and they got to hand it over to construction. Construction's got to build it, and then they got to hand it over to the management. And so one of the things that's probably most different about our firm out there is our ability to do really vertical integration. And so inside of that, we still have an asset management group and we have a finance department, but those are the real 3 lines of business. And we've been able to add, again, cost savings to add more return to our investors by having all of that fall under one roof. And that's been a little secret sauce with our size and what we've gotten to.
I often hear successful people, or even people that we used to mentor, well, the deal fell in my lap, or things fall together. They don't fall up together. It's education times action equals falling together. That's the reality. The reality is Ken could have stayed there in his cushy job, gotten fired for the 3rd time, and say, you know what? I'm going to continue doing what I'm doing. I'm 2 out of 150. I'm crushing it. I'm making great money. I love what I'm doing. But then I got that itch. I'm like, I don't want to go back to corporate America. I hate what I'm doing. My parents were both entrepreneurs. I sort of like this real estate thing. I see the future. You need to have at least 10 to 15% of your assets into something that's alternative. And oh, by the way, when I look at family offices now, that's what has happened. That's what's driven up the cost of multifamily. So if these rich, smart people are doing it, why can't I do it? And I don't have to start with a 300-unit apartment complex. I can start with a 30-unit apartment complex. I can hammer and beat down the doors of everybody that I know. Start with 50,000 here, 100,000 there. And before you know it, it's 10 years. 10 years later, I'm raising how much? $150 million a year from the mom and pops of the world. And my journey is a little bit different than everybody else's journey. I like the individual investor. The institutions aren't for me. I'm not here to tell you whether single family is better or multifamily is better. I'm here to just lay the facts of how my life has been impacted by multifamily. I love dealing with the vertical integration. 100 employees in 18 months. I don't think the average person listening has hired 100 employees in their lifetime, but that doesn't matter. You don't need to do that. All you need to do is to get crystal clear on what you want. You need to get crystal clear on what your goals are. 1 house a year for the next 5 years may be great for you. A 30-unit apartment complex may be great for you. That's what Jake and I wanted. We wanted 100 units. We thought we were going to be great after 100 units. Then you start doing it and you start building one deal. Then you start building the next deal, and then before you know it, you've done 100 projects. I mean, it's been an amazing story hearing about it. Where can the listeners get more information about working with you, possibly joining your company, becoming an investor? Where can they find out more information?
Yeah. So roerscompanies.com. So my last name is spelled Roers as in Sam. So Roers Companies, plural, .com. And If they Google it, they should find us. And just to clarify, so a couple of things you said that I love. Number one is things tend to fall in people's lap. Well, if you knock on 10 doors, one deal will fall in your lap, quote unquote. The other thing is we had a saying, and it used to be on our website, and that was dream big, start small, and scale fast. And the third piece is, I did a commencement speech a couple of years ago, and I told everybody when I got up there, I said, I know you all think I'm going to start with saying you're going to change the world and find the job that's not work, and it'll never be another work day in your life and all that. And I said, I hope you all fail, and I hope you fail big and fast, because that's where you really learn, right? I mean, we've had so many deals that have gone against us, and in 2015, we were supposed to be broke because oil prices plummeted in the Bakken and everything else, and our backs were against the wall. And the only way out of it was to grow faster than anybody's ever seen before. And we did that, right? But those are really taking those lemons and making lemonade. And that's what people have the opportunity to do. But I'd love a way to meet the folks out there and get an opportunity to partner with them in deals that we can do, or hopefully help them out in any way that we find possible from our end as well.
And I'm going to end with this. You can always get into real estate by learning while you're earning. So if you don't want to start out by yourself as becoming an active investor, you're a doctor, you're a lawyer, you want to tap into these benefits, well, Kent is the perfect opportunity. He's been doing it for almost over 2 decades. He's got a great track record. That's something where you want to start learning the business. And I love the 3-step framework: development, construction, and management. That's his buy right, manage right, finance right. He's got his blueprint. I want to thank you for being on the show today, Kent. It was a friggin' pleasure. I enjoyed this. And for all of you out there listening, my name is Gino Barbaro, and I'll see you on the next Jake and Gino podcast. Thanks, everyone.